Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning from the Asia Pacific. Our top stories today: stocks across the region under pressure as investors await major central bank decisions, key economic data, and also big U.S. tech earnings. Now, Chinese shares in focus today, with authorities taking a further step to obscure data on global flows into the onshore market. And Italy's Giorgia Meloni calls on President Xi Jinping to balance out China's commercial ties with the EU while offering to broker better relations.
Good Tuesday morning to you. I gotta say, it's pretty quiet out there, but nonetheless, we are seeing most Asian stocks declining, of course, ahead of these key decisions that we're seeing out of the Fed, the BOJ and BOE, coming up later on. So in the meantime, we're just kind of taking a bit of a pause on certain things here, but keep in mind, we're watching that Bloomberg dollar index there. Right now, we are at that 3-week high for the greenback. The BOJ begins that 2-day meeting as well. We're watching Taiwan very closely here. We are off the gates here with a downside of about 0.8%. So basically, facing some of the worst months since 2022 for that gauge here, just given this sort of tech sell-off, this rotation trade we've been talking about. And Brent, also something that to keep in mind. We actually saw oil dipping to those 7-week lows. We're briefly breaking below, well, we are breaking below that $80 level now for Brent here as well. The China story also, with the growth prospects and the faltering there, that certainly has been weighed down, helped weigh that asset class, but certainly we watch when it comes to Bloomberg commodities, continue to see continued declines across the board when it comes to that asset class as well. Iron ore is also down in Singapore today, and we mentioned about those treasuries set for a third month of gains as well as we wrap up the trading month. We talked about that Bloomberg Commodity Spot Index because China certainly is a big factor in all this as well, given just what we've seen in the data. We have Citi also the latest to downgrade growth there for the 2024. They also think it's going to be sub 5% now and more of a 4.8% print. So you take a look at how global commodities have been doing. Basically, they have seen a second straight month where basically we're poised for losses there. That is the worst streak, I believe, that we've seen since 2023 and the worst month overall for July in over a year as well. The approach to the open is looking like this here right now. We talked about the story about the flows and how we might not bet that much information on really what these daily northbound and southbound flows are going to look like pretty soon. But it's really about that CGB rally and extends into this Tuesday morning here. Take a look at how that Chinese 10-year yield at 214, that's a fresh record low that was reached yesterday. The 30-year low, well, 30-year yield, I should say, is at 237. That's a 19-year low. So we're also hitting some key milestones there as well. Dave.
Yeah, in fact, it is extending today. So the 30-year yield, as you can see, is at 237, 236, 215 on the 10-year yield. This is really top of the agenda, market's agenda for Greater China today. This unrelenting CGB rally and really testing the patience. At what level do you think the PBOC is going to step in? And basically said, okay, that's it for now. All that being said, we look where inflation is, and certainly it does give further fuel to this rally along those levels. Right, 3,400 on the CSI 300. We're slightly below that level. In fact, on Monday, we closed at the lowest in about 5 months or so, although, a brief rally could take us right back above that level. The main culprit recently have been consumer staple stocks, whether that's the CSI 300 gauge, the MSCI China gauge, which is bottom of your screen, 7-year lows as far as that's concerned. We'll continue to update you guys, of course, on this trip, of course, from Ms. Meloni in China. And we're looking at some earnings coming through today. So you have StanChart, you have Prada. China plays still. L'Oreal, of course, reports in Europe. We're looking at the China angle to that story.
Starbucks, too. Yeah.
Starbucks and Wuxi AppTech reported earnings yesterday. We'll see what reaction looks like today. Bottom of your screens, of course, that drop year on year to about 4.2 billion renminbi. But as you point out, of course, it's a big central bank rate.
Yeah, in case you didn't watch yesterday's show, we showed this graphic already about just this 32-hour spree that we're really looking ahead to here right now. And it's going to be a really interesting sort of dynamic between these three, right? Are we actually going to see the Fed signal cuts are coming? Are we likely going to see the BOJ signal or at least even hike rates? And what does it mean for bond purchases? The BOE, we talked about that, could be a bit of a toss-up here as well. Let's bring in our guest now, James Ashley, Head of International Market Strategy at Goldman Sachs Asset Management. You get a little bit of everything this week. You get a bit of central banks, you get U.S. earnings, you get a bit of data as well to wrap up the week. What's going to be the most influential, do you think?
It's going to be a fun week, but I think most obviously it's going to be about the Fed. What's the Fed going to say? And I think it's the saying rather than the doing this week. So if we look at the expectations for the market, there is some chatter out there that maybe the Fed could potentially move as soon as this week. I think that's premature, and for the most part, people are seeing that still as a tail risk rather than as a central scenario. It's really how transparent are they going to be? How pre-committing are they going to be about a possible move in September?
Is September a done deal?
No, absolutely not.
Oh, okay.
I think we're in the situation now where it's more likely than not, and our base case would be September. But if we ended up with a couple of strong payrolls prints, a strong CPI and PCE print over the next few weeks, the Fed is absolutely in the situation where they could roll back and say, actually, we're still on hold, we're watching and waiting. We think that things are moving in the right direction, but we don't have enough confidence yet to make that move. So that's why I think this week is crucial. Are they actually going to pre-commit, essentially, and say, we're going in September, whatever happens? Or are they going to say, we expect to move in September, but we're still in data-dependent mode?
Yeah. What are you going to be looking in terms of the tone? Because is this going to be a Fed that's forced to cut rates because it wants to, because the data is gradually suggesting that it can, or that it has to, because we're going to see a sudden, softness in the economic momentum that they're going to have to, cut later on this year?
I think they're doing this they're making the move, the adjustment out of choice rather than out of necessity. Yeah. And it very much reflects, I think, two combinations. Number one is that inflation has moderated quite substantially over the past 12 months. So it's still not back at target, but it's much closer to target than it was at any point in the recent past. And in a world of dual mandates, the proximity to target matters. The second piece of that dual mandate, of course, is full employment. And you've begun to see this creeping higher of the unemployment rates and loosening in the labour market. And that combination of circumstances, a weakening of the labour market, a moderation of inflation, puts the Fed in a situation now where, given how tight monetary policy is, they can begin to think about taking rates back down again.
Yeah, you're using a chess analogy to essentially tell us where the Fed is in this whole managing expectations. And dual mandate, you say, have they signaled enough that both are equally important at this point in time?
I think they have signalled, and if anything, they've kind of pivoted in the opposite direction. So the French analogy that you're talking about, in French, if you're playing chess and you want to realign the pieces, but you're not actually quite ready to move, you say j'adoube. We're talking about this being the J-doob. So the Fed isn't quite ready to make the move yet, but they're beginning to realign. They're beginning to say, actually, our priorities are beginning to tilt towards the labour market. We haven't forgotten inflation. We can't say the job is done. It's not done. But we're beginning to send a signal right now that the labour market is at least as important as inflation. And given the weakening that we're beginning to see, and it's very much in its infancy, we're not talking about any major labour market correction, but they're beginning to see some degree of loosening of the labour market. That gives the Fed the capacity to say, well, actually now, on the basis of a dual mandate, we can think about taking rates down.
In terms of the approach to equities, or even just markets, I mean, is it still this rotation trade that you think might still have some traction? Is it the carry trades that you think also can unwind further? And what about commodities?
Yeah, so if we do that in the equity space to begin with, I think down and out is the way to go. So if we're thinking about US equity markets, obviously we've seen some rotation over the past few weeks away from US large cap, more into the small and mid cap. I think that's got further to go, particularly in this world where we've just talked about the Fed is beginning to think about taking rates down. You think about which types of companies are more rate sensitive. It's the small and mid cap. So they should be beneficiaries of that, and the valuations are a lot more compelling and interesting than, say, the large cap in the US. You then say, outside of the US, where do you go? Well, look at economies like India, where you see this strong secular growth story, and you've already mentioned Japan. You think about Japan, it's the one developed market where inflation is not a problem, it's a solution. And therefore, whatever you think about the BOJ doing over the course of the next week or the next couple of months, you're still in a world in which monetary policy in Japan is going to be very loose by international standards for an extended period of time. So we think about what does that mean for equity markets. I think Indian equities look attractive, Japanese equities look attractive, and small and mid caps in the US look attractive.
What keeps equities doing well? Because in previous cases, not all easing cycles, the stocks did well up until the point we entered an easing cycle and then sold off. So what makes this year different, do you think?
Well, I think the difference this time is that we're not likely to be seeing a recession in the US. You think about previous episodes where when you've seen the yield curve inversion, you've tended to see a recession in a short period of time thereafter. When you started to see central banks cutting, it's normally in response to a recessionary scenario that's shaping up. Right. We're not in that situation right now, and we can talk about the reasons for that, but this cycle has been exceptional. So what is different this time is that we're simply not expecting a recession. So I think it puts us in a very different situation in terms of what you should expect from risk assets.
You mentioned Japan, you mentioned India as other markets outside the U.S. It seems like you're sticking to those winners. What about China? Where does that fit?
I think China has got some really exciting opportunities, but it's very much about being granular and active in that space. So whereas I'll make the blanket statement, and of course you still need to be active, but the blanket statement about Japan or India, that we really think that's an exciting exposure to have right now. In China's case, it's much more about, well, which sectors or which individual names. So we do see some great opportunities, and the valuation's clearly a lot more attractive than you see in, for example, the US. But where's the underlying motivation to say you're going to see this continued upside? David, you were just talking about how you're beginning to see one or two houses revise down their China growth forecast. So what does that mean in terms of near-term macro momentum? We actually see this ongoing sustained growth in China. We've been of the view that Chinese growth is going to be just below 5% for some considerable time. So we're not seeing any major shocks or need to revise that. But I think you've got to be quite active in that space.
Right. I mean, you know that, we know that. How receptive are investors outside, where you're based, for example, to that idea that this market does present some opportunities, of course, risk-adjusted?
I think very much so. So we've been in a world where for quite a significant number of years it's been either risk on or risk off. Right. And it's been very binary. I think that's a simplistic way of putting it, but it's been, the overall characterization has been risk on or risk off. Now we get to a world in which it's, well, what type of risk do we want to take? Is it in the equity space? Is it in the credit space? What about duration? So it's no longer just about one market. It's about across all asset classes, thinking about how we position. So I think clients and investors are very receptive to that view right now.
And how do you look at the fixed income space now, compared to equities?
I think fixed income's actually a really great place to be. The start of this year, the fixed income trade was the one that everyone was jumping on. We thought that was premature. We were saying quite candidly, look, the market's got 7 rate cuts priced in from the Fed. They're not going to be delivering that number of rate cuts. So let's be a bit realistic about how we've probably reached peak yields, but actually the potential for there to be a significant rally over the course of this year is somewhat limited because the Fed and other central banks are going to be somewhat more conservative than the market is anticipating. We've just started this conversation saying, well, look, the Fed and other central banks are now beginning to prepare markets for imminent rate cuts. So we're now at the point where we think, actually, the yields that you're getting in fixed income markets starts to look really attractive. So we'd be leaning quite heavily into fixed income exposure at this point in time.
So the rate cuts coming, we know that. How deep we get in the next cycle is the other thing altogether, right? Because that determines value right now in these markets. Where do you think, how deep do you think we get next year? Or who knows when the cycle actually ends?
Yeah, I think that's a really good question. So I think actually it goes beyond the next 12 months. So if we think about when does the cycle end, it's probably beyond 2025, sometime into 2026. Okay. The more important part of your question, what's the level at which we end? I think we're probably looking at a neutral Fed funds rate of somewhere 3-something. It's got a 3 handle on it. If you look at what the Fed themselves are saying right now, they're saying 2.5, 2.6. So we would expect the Fed themselves to be revising up what our star is. And if you look back to where we've been for the past 15 years, it's clearly a very significant shift. We're not going back to this world of ultra-accommodative monetary policy, and that reflects a number of secular macro changes that create inflationary impulses. So rates coming down substantially from where they are today, but settling at a level that is quite considerably higher than where we've been used to for a generation.
So if the Fed does start to cut, I mean, what asset class do you think actually benefits the most then? Out of all what we've discussed so far, is it still the equity space? Is it still the bond space? Or are you looking elsewhere?
We still think it's equities right now.
Equities?
Yeah,
okay.
Yeah. And I think you still need to maintain a very sizable allocation to fixed income, and that would probably be primarily through govies rather than credit. I think the one asset class where you could say there could be a bit of a squeeze, not in the short term, but in the medium term, if you look at the spreads in credit markets, both in Europe and the US, you'd say they're relatively tight. So if you were going to be a bit more cautious, I think I'd express that through credit markets. In the short term, I think govies and equities, they both look pretty attractive right now.
James, it's nice to see you. Have a great rest of your trip in the region there. James Ashley there, of course, head of international market strategy at Goldman Sachs Asset Management. Right, just ahead here on the show, we'll talk about the Chinese economy with HSBC. They join us in a couple of minutes. You'll hear why they expect a further cut to interest rates as we go into the next couple of months or so, with Beijing looking to shore up near-term growth and confidence. Counting down to the open of trade, a Tuesday session just over 15 minutes away in Shanghai, in Shenzhen, and here in Hong Kong. Futures are pointing down. This is the China Show.
All right, your renminbi fix just crossing your Bloomberg here this morning, and we're seeing it at 713.64 here. So it is triggering a little bit of weakness in the currency here this morning. We're at 727 levels right now, Dave.
Yeah, we're going through asset classes here. So that's the currency. The bond markets is where, of course, we're still focused on, given the massive rally yesterday. And by the way, it's early days, but it's still green across your bond screens right now, all the way down to your 30-year yield. We now have a 214 handle on the 10-year yield. That's a new record low. The 30-year yield is now the lowest since 2005. Right. From this, we go to equity markets, and certainly when you look at price, we're poised for some weakness, particularly onshore. You look at some of the price action and the flows in the ETF space in the U.S., investors have been selling many of these names or products with heavy exposure to Chinese stocks. That's really ahead of what we've been talking about. A fairly busy central bank schedule. You have economic data, you have earnings coming through, and of course in China's case, that's in the form of PMI numbers around midweek. Charlotte Yang's here with us, our Asia equities reporter, to tell us more about what's going on and why people are leaving this trade for now.
Yeah, so judging from last week's flow, we're seeing ETF investors turning more cautious towards EM stock, especially China ones. So you have the Vanguard FTSE emerging market ETF, which is the world's second largest tracking emerging markets, and so with the heaviest country exposure on China. So this ETF has seen its largest weekly outflow in over 4 years. And also you have MSCHI, which is the largest ETF tracking China stock, and they saw the largest weekly outflow on the record. So I think it makes sense because with the busy schedule this week, and we have the factory activity data from China coming out tomorrow, traders are getting more cautious, but also market watchers are saying that this confirms the trend they're saying, which is investors now growing more sophisticated with EMS. They don't like to buy it on a basket. They probably prefer themes such as EMX China or specific ones on dividends or on consumption.
And it seems like market watchers are not going to be able to see one key sort of data, which is some of these northbound flows. We kind of heard a little bit of why they were doing this earlier this year, but tell us a bit more about the rationale behind it.
Yeah, so starting from August 18th, China will start publishing the daily flows of overseas funds going in and out of Chinese onshore market. So essentially what this does is that it's shut down a window for investors to calculate the net flows at the end of each trading day. What they will publish on a daily basis is the total turnover for the market, also turnover for the 10 top most active securities and number of trades for stocks and ETFs. But this effort came after authorities have been really trying hard to prop up confidence for the onshore investors. Sometimes, maybe smoothing out the impact they see whenever there's a big sell-off, from overseas funds to China. But to be sure, you will still get to get directions of how foreign funds are going in and out, but on a quarterly basis. So there will be this report published by the central bank, but on a quarterly basis. And also the real-time trading flows of how onshore funds go into Hong Kong stocks are not affected.
All right. Charlotte, thank you. Charlotte Yang there, our Asia equities reporter watching these Chinese markets for us here. Let's talk about what Singapore's state-owned Temasek is saying now. It plans to invest $30 billion in the U.S. market over the next 5 years as it remains cautious on putting money into China. Let's bring in Avril Hong. She joins us from Singapore with more on this Bloomberg interview. And Avril, maybe tell us a bit more of the why. What's behind this focus on the U.S.?
Yeah, it's coming at the time of U.S.-China strategic competition, and it's making it increasingly difficult for investors to navigate. So this latest shift is just part of that. We've seen how the two have gone head-to-head in the arenas of chip-making firms, for example, seen as crucial for AI development, for what we're seeing in the digital economy. The U.S. has been trying to curb China's rise via export controls, via tariffs. So Temasek's head of North America basically saying that the Americas will continue to be the largest recipient of capital going forward here, $30 billion of plans to the U.S. over the next 5 years. This will come into the investments related to AI, whether it's some of the semiconductor-linked names or even infrastructure plays, such as data centers. And it's worth highlighting that this is coming at a time when the Americas actually accounted for even more of the portfolio than China for Temasek, about $63 billion, or roughly 22%, versus China's 19%. This is the first time we're seeing this in at least a decade, guys.
Yeah, the U.S.-China tensions comes to mind here. Just having a look at the graphic we just showed, it looks like, to your point, Avril, they're simply rebalancing it and focusing more on the U.S. We're just getting a line coming through as well here out of this defense meeting in Manila to the point on tensions that Lloyd Austin has told the Philippine President Marcos that they are looking forward to 4 more years of strong ties. Along that note, how else is Temasek looking to navigate things like that, looking to navigate U.S.-China tensions?
Well, for now, it says that it's going to be kind of keeping out of businesses that could be in the crosshairs of geopolitical tensions. In the arena of China, for example, it's kind of avoiding those geopolitically sensitive areas, and it's focusing on some of the large domestic firms. It's looking to kind of put in new investments in EVs, in biotech, and it says that there are ways that it can structure investments to avoid some of these constraints, and this could include taking, passive public equity stakes in some of the listed chip firms. So these are among the ways that China investments are, being navigated by Temasek.
Avril Hong in Singapore for us going into the open today. Have a look at where we are on the Hang Seng Index. Of course, we're still looking at the CGB markets, and you have a 214 handle on this. The opening bell 6 minutes away. You're watching the China Show. Okay, subdued open, I think, is the way to put this. 0.25%. We're coming off, by the way, a very good day in Hong Kong yesterday. When you look at onshore markets, they have been range-bound to the downside mostly, depending on which benchmark you look at. Earnings, of course, in focus. Wuxi Aptech, bottom of your screen.
Yeah, so we're up about 3% here. So they did talk about shrinking sales here. Revenue from U.S. clients also fell, but revenue was still in line with estimates, also touting that strong pickup in the order backlog, which was a key concern given this looming U.S. bill as well. So certainly we're seeing a bit of upside there today. Analyst actions to tell you about J.P. Morgan downgrading China Mengniu Dairy to neutral. They're talking about a further decline in raw milk costs, mainly to more discounts, and will drag down their sales as well as their margins. Jiu also cut to a hold at China Renaissance, Rio Glass. That one call from Daiwa as well. Futures are pointing lower. We have an open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're coming down to the open of markets, of course, in Hong Kong, Shenzhen, and Shanghai. We talked about Hong Kong having a good day yesterday. May not be that much of a case here today, but it's quiet, right? We're still waiting for all these key central bank meetings as well. And you keep in mind what's been going on in the CGB market. It's really a lot more active in bonds than in equities of late there. 727 for your dollar China trade here this morning. We didn't get too much in that fix here, but really this CGB rally, you got to wonder when it's really going to start hitting the PBOC and saying, look, we got to do something.
Yeah. Often enough when that happens, it's after the fact.
Yeah.
Right? They're going to come out and do something. You'll see something in markets. We have about 7 seconds to the open, so I think I still have some time to go. Yeah, Hong Kong did just win their second gold medal.
Yeah, they
overnight.
did.
There we go. Okay, it's quiet. Anyway, back to markets, just in time. There we go. Declines. CSI 300, 33.80 right now. So we did close, by the way, already at a 5-month low yesterday. So we're continuing to see a downdraft there. We're getting some downgrades, in fact, here on some of the liquor makers. More on that, I guess, later on. Malta is down about 1%. CATL, of course, out with earnings this week. And, like this graphic tells you everything you need to know about the market story today. And it's quite blatant, isn't it? The 10 and the 30-year yield in green on your screens. The rally continues, as Yvonne was pointing out. Let's flip the boards, please, if we can, and have a look at the open in Hong Kong, where we are likely to see just, there we go, 0.8 of 1%. So we're giving up some of the gains yesterday, not everything. We have earnings coming through today. I think StatChart, Starbucks.
Yep.
Prada, L'Oreal, and some of the China components, I guess, of what those businesses look like. I mean, if you had a look at Europe yesterday, Heineken, of course, had to take that impairment because of their exposure in their stake in China Resources Beer. In fact, let's have a look at some of those names that have reported earnings so far. Wuxi Aptech is getting some upside today, 4.5% after earnings coming through. Fuyao Glass also report. That's also an earnings story, and we talked about Prada and also Stan. Second day I'm talking about Prada. That's probably a record itself.
think they're happy that you're talking about it.
Right? Okay. Let's change topic, please.
Yeah, they are talking about, given what we've been hearing from some of these European companies and the luxury sector, China certainly is going to be that key focus on how big of a headwind it's really going to be. And it has really impacted a lot of these stocks as well, given the earnings outlook. But there you go. You talk about consumer stocks, though. I mean, that is also seeing a drought. This is the MSCI China Consumer Staples Index. So I think the decline's already from the top to where we are right now, and we've seen a massive drop in the last 2 or 3 weeks here. We're now worse off compared to the worst point of the GFC as far as the drawdown is concerned. And a lot of this comes down to the fact that when you look at investors, they try and gauge what part of this economy is doing well, not doing well. They stay long quality names, large caps, consumer staples. Not part of that. So these are your Nongfu Springs of the world. Yes.
These are your Guizhou Maotais of the world. And you are seeing markets expressing that concern through this. Yeah, let's bring in the next guest, Jing Liu, Greater China Chief Economist at HSBC Global Research. Yeah, we talk about the consumption obviously still being weak. This recovery appears to be losing momentum as well. But it's been a busy July, whether it's plenum, surprise rate cuts, the weaker data. Is there anything that we've seen this month that they could change the trajectory in any way?
I think actually there's quite some information in the third plenum, especially when I read the full context of resolution. Of course, there's no direct cash handout to the consumers, but we do see there's a lot of reform being planned, which in the longer run can support the consumption.
Yeah, tell us what stands out to you the most among everything. Our economists at Bloomberg Economics say that there seems to be a coordinated effort in the last 2 weeks to gear us up for something that probably is ahead.
Yeah, definitely. We have seen, for example, the fiscal stimulus, the $300 billion for the trading of consumer durables, and also the rate cut. But I think most interesting is that in the third plenum resolution, it says that going forward, we're going to see the provision of public goods and services according to the permanent residence. That's a big deal because in the past, it's more or less related to the hukou registration, which means in cities with large population inflow, probably we don't have enough soft infrastructure and also hard infrastructure. So if people are given more social benefit, they probably have more spending power, the living salaries, so to speak. That is something which stands out. And the second thing, also talking about the new productive forces, it says that it's going to be suitable to local conditions, which means in the current situation, we see a lot of resources being devoted to EV and other things, probably also cause the criticism about overcapacity. So this time around, there's a pledge to basically enhance fair competition, including to provide the equal market access as well as the protection for different kind of enterprises. And very unusually, it talks about it's going to tackle the local protectionism through basically trying to prevent the illegal subsidies, etc.
You mentioned the first thing about these consumption programs, the 300 billion renminbi that's been allotted. Do you think subsidies alone can actually boost demand? Because these funding programs are not really anything new, and we've already said the funding is going to come from these already announced bond, these different issuances from bonds as well.
Yeah, I think to some extent it can help. For example, this trading program for the vehicles, I think a lot of people are happy to tap into that. But the subsidies alone only have a limit. So we will have to see basically the improvement of the consumer sentiment. That will depend on all those ambitious reform measures announced, and we need to see how they are going to be implemented.
Yeah, and I think that brings to mind the retail sales number from the last month, which if I remember correctly, was 2%. Is that number that low because there's no inflation, or is that fairly reflective of also dampened spending on volumes, for example? I'm just wondering if that's a price function.
I think there are many different reasons behind that, and obviously we see the consumer sentiment still hovering around the low point. That plays a big role into that, and that is due to many factors, such as balance sheet impairment by the household. We see the housing market still struggling. Equity market is not performing that well yet. So from the asset side, there's some impairment, and then the recovery is on the way. And also in terms of the income expectation, I think it's fair to say for middle-income group, probably the labor market still needs way to recover.
Just given these surprise cuts we really got after the plenum, what did you make of this, right? And is there more cuts to come, do you think, after this?
I think several things I want to highlight. First of all, actually, Governor Pan Gongsheng from PBOC highlighted the change of monetary policy framework 1 month earlier. And he said that PBOC will move towards a single anchor, which is a 7-day reverse repo. And we did see basically the cut by that rate is followed by market rate change. MLF cut, I think, come after the market rate already responded. So that's a way to show in the future, the MLF will be downplayed. And this is also a stance basically trying to underscore the pledge in the plenum that China will basically decisively make measures to meet this year's growth target. So in a way, the government is aware of the challenges and is willing to pledge more support.
Do you think banks will extend more credit in the future? Because part of the reason I ask that is, you lower rates on the low end, you're getting also some of the banks adjusting their funding and the deposit rates, so you have a protection in margins there. And then we've also seen the PBOC trying to manage the yield curve to be slightly steeper than the current level. It all sounds like they're trying to encourage banks to lend more, that it's not going to hit their profitability if they do so.
I think, we all watch the net interest margin. That definitely will play a big role in the bank's profitability. Right. But in terms of whether the banks can successfully lend more, it also depends on the demand side of the function. That is why changing or improving the sentiment, both for the household as well as for the business, will be very important.
Given just what we've been seeing with the CGB rally, I mean, this is, of course, after these cuts that we've seen. I mean, is the PBOC likely going to have to intervene in some way? I mean, this is already we're at levels that have surpassed what most analysts thought was going to prompt some sort of intervention.
Yeah, I think that's a tricky call. We all know the PBOC always needs to basically balance different kind of targets. It certainly says at one point of time it wants to see the yield at a reasonable level, but it also needs to consider, what to prioritize. Like right now, probably trying to guide the overall, sentiment towards more willing to borrow will be the priority. So I think, so far we cannot rule out more cuts on in the cards.
What else do you think is important for us to keep in mind that we haven't touched on? What doesn't worry you at this point?
Well, actually, I think the housing market is still quite vital. And interestingly, when I read the resolution, probably fair to say not so many surprises in the wording. However, during the press conference, the day after the plenum ramped up, the senior official Han Wen-shou actually said the housing sector is of systemic importance. That is something new. And if something is of systemic importance, usually we only refer to the financial sector. Right. That means it might justify bolder steps ahead by the Chinese government.
Right. And such as what? Like what haven't we heard?
I think it has to be from the central government. So far, we have seen a lot of measures, but we haven't seen central government put its skin in the game. So I think it's possible the central government will use its own balance sheet, trying to, for example, acquire some of the oversupply commodity housing and convert that into the subsidized housing.
These are great insights. Thank you so much. And all those comments, of course, coming through the detail there out of Jing Liu, Greater China Chief Economist at HSBC Global Research. Right, just ahead here in shows, we'll get you the latest what's taking place in Venezuela with President Nicolas Maduro's election win. Has protesters on the streets while world leaders call for a full accounting of the vote. The latest just ahead. This is Bloomberg.
China congratulates Venezuela on its successful presidential election and congratulates President Maduro on his successful re-election. China and Venezuela are good friends and partners who support each other.
And that was the Chinese Foreign Ministry congratulating Venezuela's Nicolas Maduro on his disputed re-election victory. Now, of course, Venezuelans are taking to the streets here, the capital, in protest after President Maduro claimed victory in Sunday's election. Now, Maduro is also facing calls from the U.S. and several Latin American countries for a full accounting of the vote. Let's take you straight now to Bill Ferries. He's with us right now, senior editor. He also previously covered LATAM, of course, for Bloomberg. So, Bill, you're fairly familiar with what's going on and the dynamics between, not just in Venezuela, but between Latin American countries as well. I guess just take us to the latest and whether we should expect more pushback from some of its neighbors at this point in time.
Yeah, thanks. So, yeah, I was there in 2012 for Hugo Chavez's last election, and I think all of Venezuela's elections under Chavez and Maduro have been tainted by accusations of fraud. But I think, having said that, what we're seeing in this case seems to be on another level. The opposition now says that they've seen the individual results from about 70% of the polling stations around the country, and their numbers show an overwhelming victory for their candidate over Maduro. So, and what we're starting to see now, besides the protests in the streets and the opposition from countries like the United States that you would expect, there's actually some of Venezuela's more traditional leftist allies in the region, including Brazil, Mexico, Colombia. They are talking about not going forward and endorsing this victory until they've seen all the individual voting data, until there's more transparency about what happened at all of these polling stations around the country. So while we had China at the top congratulating Maduro, we are seeing some Venezuela's more traditional allies not quite going that far, given the events that are taking place on the ground.
Yeah, and we've seen certainly the market impact. I mean, some of the bonds that we're seeing in Venezuela basically are trading around 13 cents on the dollar after this sort of political turmoil. How should investors and international investors be looking at this country now? I mean, certainly we're looking at what's next. What are some of the key things that we have to look out for?
Well, there had been hopes that if this was a relatively free and fair election, even if Maduro won, that there would be some kind of easing of sanctions. There would be talk of a debt restructuring. As you mentioned, though, the bonds fell 12 cents on the dollar. For some of those, 12, 13 cents on the dollar. I would be expecting possibly more sanctions coming from the U.S. and some other countries. I think it means it's going to be more difficult to upgrade Venezuela's oil industry. I think they're going to remain isolated for quite a while longer until there's a chance to sort out exactly what may have happened here.
Bill Ferries in Singapore for us, our senior editor, getting us up to speed here on what's taking place there and also some important, of course, context. Right. Italian Prime Minister Giorgia Meloni is, of course, in China and has offered to broker better trade relations between China and the EU. It's her first visit, of course, to Beijing since she took office. Min Min Lo, our China correspondent, is here with us on set to take us through, of course, I think it's day 2 or day 3 of this visit. And she had her meeting, of course, with Chinese President Xi Jinping.
Yes, so she's really trying to achieve a number of objectives for Italy here. She wants to reset relations after she had pulled out of the Belt and Road Initiative, which is quite tricky after she had called that a big mistake for Italy. And now she wants to offer to broker better relations for the EU after Italy had supported those EV tariffs on China. And at this point, it's also not clear how much sway Meloni actually has over the trade policy of the European Commission, given that she was sidelined after the European parliamentary elections in June. She was kept out of closed-door negotiations for the union's top jobs. But certainly both countries are trying to manage any potential fallout from those tariffs. President Xi is saying that he is hopeful Italy will provide a non-discriminatory environment for Chinese firms, while Meloni is calling for a more balanced trade relations because these two countries still have $80 billion in annual trade that is heavily tilted towards Beijing's favor. And then, of course, you have those geopolitics in focus as well. Meloni raising the issues of the Gaza conflict, the Ukraine war. She sees President Xi as this important interlocutor when it comes to managing global tensions, especially ahead of the U.S. elections, where there's some uncertainty over whether the U.S. would upend its relations with the EU. And Meloni is trying to position herself as this key counterpart to President Xi now.
And we've seen also with President Xi is stepping up efforts to position himself almost as like a peacemaker for ending Russia's war in Ukraine. Tell us more.
Yeah, again, Beijing is making use of this window of opportunity where there is a lot of uncertainty over Washington's commitment to Ukraine. And last week, Beijing had hosted the Ukrainian foreign minister and said the conditions were not ripe for peace talks. And now they have followed that up by sending its peace envoy, Li Hui, to South Africa, to Indonesia, to Brazil, these countries that have not imposed those US-led sanctions on Russia, to create the right conditions for the resumption of talks. And remember, Beijing had skipped the peace conference in Switzerland because Russia was not invited to those talks. They've been calling for an alternative peace conference, and it looks like now they are laying the groundwork for that conference, maybe in the second half of this year, perhaps before the U.S. elections. Certainly part of President Xi's ambition to position China as this alternative to the U.S., a force for global peace. But of course, Beijing's support of Russia has cast some doubt over its neutrality and whether it can successfully extract the sort of security guarantees that would be amenable to the parties of the war.
Min, thank you. Min Lo there, our China correspondent, joining us there with the latest. We got plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Here are some big corporate stories we're tracking at this point. Energy trader, the Vittle Group has paid a record dividend of, $6.5 billion dollars last year after Russia's invasion of Ukraine delivered this massive profit boom. Now, the payout represents an average of $14 million for each of the 450 employees who own the company. Now, Bloomberg calculates, of course, that the company has distributed more than $25 billion to its partners over the past 15 years. Now, McDonald's has shrugged off the burger chain's first sales drop since the pandemic, so pledging to launch a new promotion. Second quarter comparable sales actually fell 1%. That's year on year, with the CEO Ian Borden warning of further weakness as cash-strapped consumers curb their spending. But investors retained their appetite, with shares posting their best daily gain since 2022. Now, Disney's Deadpool and Wolverine has clocked the biggest box office opening of the year. Speaking of movies here, it took a $211 million in North America during the opening weekend in cinemas, but it couldn't clinch the top spot in China, beaten by a local comedy successor. Now, that underscores, of course, the challenges Hollywood studios still face in China, which was once a goldmine for U.S. releases. Now, shares of Heineken that absolutely watered down in Europe. There we go, 10% drop. That's after the beer maker took a close to $950 million impairment on its stake in China's largest brewer. Now, it says the value of its stake in China Resources Beer tumbled on concerns about consumer demand in Asia's biggest economy. Now, a similar weakness in the U.S. and Europe saw the brewer narrow its forecast for full-year profit growth.
All right, another check these markets.
Impairment that we had to take, a non-cash impairment, is a technical adjustment that we have to do because as a minority participation, we need to value this on the share price, and the share price of CRB listed in Hong Kong dropped below the level that we acquired the company.
Another check of these markets here right now. It's the earnings picture, as we talked about with Heineken, the like Wuxi AppTech. That one is getting a bit of upside in that stock here. A bit of relief from investors here. So they did also, their revenue was in line with estimates. They talked about that strong backlog as well. So that certainly did help the stock here this morning. Fuyao Glass appearing, I think there was an upgrade there from Daiwa this morning. And we're watching Prada, Stanchart reporting earnings a little bit later on. Obviously, we've been focused on, the weakness in China, how it's impacting the luxury space. And that certainly is a key concern for Prada as well. Shares down about 3% right now. Yeah, so the next few hours will be pregnant with possibility, let's put it that way, right? In terms of some of the conversations we should be getting into as well. Not to also mention, so we don't see it on your screens, as we move into the European session, you have inflation numbers coming through. And of course, just in case you missed it, we are at day 1 of 2 of the BOJ meeting. And we are already starting to see some measures of hedging and costs of hedging and implied vol on the yen, for example, starting to move against the grain. Okay, we're looking at equity markets mostly to the downside. What is that? I can't see that. I can't read that market. The hue of green is a bit too
Anyway, my producers will tell me what that market is. Can you make it out?
Malaysia?
Yeah? Malaysia. Okay. Not truly Asia today because we're looking at declines across the region. Banter, of course. Commodities also, which is your middle column right now, seeing declines in copper, aluminum, and rubber, and also iron ore over in Singapore. Right, coming up next, we'll be talking with Poole out of Oreana Financial Services on his market calls ahead.
Welcome back to the China Show. Here's a look at the HSI half hour into the session. We're extending those declines here right now, and now at session lows about 1.5% or so, similar to what we're seeing with 8 shares. So certainly it's a down day across most equity markets here as we count down to, of course, the Fed, the BOJ, as well as the BOE this week as well. But yeah, what's not actually heading lower is the CGB market.
No, continuing to see new highs. So the 30-year yield, well, 30-year futures, we hit that record very recently on the 30-year yield itself. So I think we're now trading at 2.37, 2.38%. I think we have a CGB board to show you in a moment here. Do we have it? I think we do, right, guys? Anyway, we're going to show that to you once we, well, since I'm calling for it, we're going to show it very, very soon to you guys. We're looking at equity markets down about 0.9%, of course. So here's what's happening, right? Sort of the market leaders from the first half of this year, and Japan and India, those two markets. Well, Japan, India, and Taiwan. Let me just dissect that. So Japan is actually down 8 in the last 9 days or so on the Nikkei 225. Taiwan is actually headed for its worst month this year. And only India has actually held up quite nicely among the drivers of this Asian equity market. So we're seeing consolidation from the past winners, not really into the underperformers, like this Chinese market, which is still range-bound. So where is that money actually going at this point in time? As promised, very, very quickly, have a look at where you are in CGBs. There we go, and we're hitting fresh lows on the 10-year yield, 2.14%, and a 2.37% on the 30-year yield. Takes you to the lowest since 2005.
Yep, let's bring in Poole, Global CIO and Portfolio Manager at Oreana Financial Services. Isaac, it's always great to have you. We can't stress enough how important this week is, but you're saying it's time to fade this rally in equities. Why?
Yeah, I mean, I think when you look at where valuations have got to, they're very stretched. And when you consider what that's pricing in, it's not pricing in a soft landing anymore. It's pricing in a re-acceleration of growth from here. And that is not the trend of the economic data. There's no amount of rate cuts that can be implemented now to really drive that re-acceleration of growth. So we think that there is a scope for equities just to continue to trend lower from where they are now.
Wait, Isaac, to clarify, are you alluding to the Fed being severely behind the curve here?
I think they're behind the curve. They've been hoping that they can implement these surgical, precise rate cuts and engineer a soft landing. But the economic conditions are not the same as they were back in 1995. Take the unemployment rate as an example. It's very low and it's moving higher. In 1995, it was high and it was moving lower. We will most likely get a rate cut in September. But the real risk here is that the Fed then has to move to emergency mode and cut rates maybe 0.5% in the back half of this year and another 0.5% next year. And those type of rate cuts are not positive for equities. They will be negative.
And what does it mean for Treasury yields, right? I mean, the 2-year yield, you say, could actually rally lower to 3% or even below that. That's quite a drop. What's going to take it there?
It's that bull steepening that you see when the Fed moves to emergency cut mode. The market moves to price in not just one, not just 2 cuts, but 2% or 3% of cuts. That is historically the minimum required to move an economy out of something closer to a slowdown to a recovery. And I think we could really start to see that gather pace in through 2025. And by the first quarter or the second quarter, we certainly could see 2-year yields that much lower. And I think that will be across the curve. At the moment, there's this bull steepening view that it will be driven only by the front end of the curve and the long end will be held up by concerns around the deficit. I don't think that will happen. I think you'll see the entire curve move lower, led by the front end with a real bull steepening as markets become more concerned about the pathway for the US economy.
So give us a rough number, Isaac. How overweight should I be in fixed income, particularly in treasuries, as you lay out those two philosophies?
Yeah, look, I mean, that's going to depend on your portfolio settings, but we would be looking to be moderately overweight, and that means really loading up at the front end of the curve, maybe out through to the middle of the curve. When you get out towards the 10-year part of that US Treasury curve, it's not as attractive as it was a couple of months back when it was at 4.5% and above, and we were really banging the table there saying, here's a great opportunity. Look, it's not as strong an opportunity, but you're going to get some good risk-adjusted reward there if the Fed does start those emergency rate cuts. We do believe that 10-year will be forced lower if the economy continues to slow as it is.
Wow. Yeah, it's interesting. Does the U.S. election in any way change your view, Isaac, about that call?
Well, I think that a lot of the concerns around the US election have been around the prospect for deficit spending and ongoing widening of the deficit and the potential for that to be inflationary and to push 10-year yields higher. And yes, that is a concern, but the fundamentals of the economy will dominate in the near term, and those fundamentals are weakening. I think we'll see it in the manufacturing PMI this week. I think we'll see it in the unemployment rate this week. And those type of slowing growth fundamentals will exert more downward pressure on the long end of the curve than the election will come November.
Isaac, we haven't talked about, you have some big tech earnings this weekend. Granted, to your point, that we have seen the market, the reactionary function of markets have been really to sell bad earnings and not really act on good earnings as well. But what if we get really good tech earnings this week? Can this change the trajectory in global equity markets? Those are very, very big stocks that are reporting this week.
Yeah, I mean, in the near term, I think the answer is yes. If we see a really positive surprise, I think not just in earnings, but it's now moving to that focus on the outlook, and it's a show me the money moment. People are asking, you've invested all this money, where are the revenues, where are the productivity gains, how's this going to translate over the next 3 months, 6 months, 12 months? And those sort of questions need to be answered, notwithstanding the positive earnings that we are likely to get in Q2. So there's a question mark. And I guess the difference that you're seeing now is that markets and investors are punishing any misses, but they're also certainly looking to punish any guidance that falls short of what has become very extended expectations.
Yeah, and if you're saying, you know, prepare for maybe some sort of recession risk in the U.S., I mean, what does it mean for overall China, if you look at it as a global growth perspective, right? We're seeing this recovery really start to lose some momentum here right now. How do you look at this China market, and what exposure is appropriate?
It's a challenging market, and it's going to continue to be a challenging market because we've just not seen China's authorities willing to implement really solid monetary or fiscal policy support for what has been a disinflationary and outright deflationary economy over the last 6 or 12 months. And I think that will continue. The difference could be that if we see the global economy slow, that may be exactly what China is waiting for. They are holding some monetary and fiscal policy support back. I think they've been drip feeding it with the expectation that the global economy will slow, and they want to have something held in reserves to support. So that will continue to be a challenging market. I think there will be a global slowdown that will impact China, but you can be sure, I think, that if that happens, you will see more support come out of China in a more significant way than what we've seen so far.
And does that not present at least a tactical opportunity, Isaac, in your view, when you look at Chinese market? I mean, you have everything you need for a market to rebound, right? You have cheap valuations. If your concern was valuations were too high elsewhere in the world, it's the opposite here. And then you have just unprecedented stimulus either in the market or waiting to be deployed.
Yeah, that's right. And I think there will be that opportunity, but it's going to be difficult to lean against what I think is slowing momentum over the next 6 months at the very least. But when and if we do start to see that momentum kick lower, there's going to be the mother of all buying opportunities, I would expect, because those relative valuations are so attractive. And for people who are looking to perhaps get a little bit of downside protection, China could be a way to play that.
How do you express that sort of global growth slowdown as well? I'm looking at the yen and the surge that we've seen this week. Obviously, it's the unwind of the carry trades, but maybe you get some of those traditional haven flows back into this currency as well. But do you think this yen is going to sustain this sort of strength even after this BOJ meeting?
Really hard with the yen at the moment, because you just cannot underestimate the willingness of the Bank of Japan to do the opposite to what the market expects and to wait too long to do the right thing. And we've seen that so far already over the course of this year. That said, there is, we think, the likelihood and the possibility of those safe haven flows returning. In the near term, I think there's a lot of event risk around the Bank of Japan this week. The real risk, they just don't cut and they underwhelm with the rollback in bond purchases, because that has been their MO for the last many, many years.
Right, okay, well, fancy a guess for us. Do you think 145 is next or 160? What's the next level we touch in the yen here?
Yeah, I mean, I wouldn't. I would expect 145 is more likely than 160, but lock in some volatility over the course of the next 5 to 10 days.
Okay, the equity markets have been consolidating in Japan. Was that it, or do you think we're just gearing up for something more? And what could be the next catalyst? You know, what have markets not priced when it comes to the Japan story?
Yeah, look, I mean, I think the move in the yen and the strength in the yen has been part of that, as the weakness of the yen was part of the positive for the equity markets. You know, I would expect that if we get a global slowdown, there is no way that Japan is going to be immune to that. And just to be prepared that there has been some really strong gains over the last 12 to 18 months, it would be completely normal for there to be some correction there. But it's the long-term structural story that is such a positive for Japan at the moment. I don't think that's going away. I think that Japan is back as an equity market that you can actually play with some confidence. But the near-term risk is for that to just consolidate a little bit further.
Isaac Poole, thank you so much, sir, for your time. Global CIO and PM, of course, at Oreana Financial Services there. Live for us out of Bernie. Okay, just ahead here and shows how defaulted Chinese builders are giving liquidators a series of headaches. More on this story just ahead. This is the China Show. Welcome back. We're about 45 minutes into the cash market session, so we're just coming off lows in the day. We briefly dipped under 17,000 on the Hang Seng Index. As you can see, we're slightly above that, but all things equal, of course, we're looking at a fairly bad down day across these markets. CSI 300 is down about 1%. There we go.
Yeah, we're talking a little bit more about what's going on in the property space. Obviously, liquidators are trying to recoup at least a fraction of creditors' investments in defaulted Chinese builders. They're really running into some dead ends right now. Let's get to our credit reporter that covers China, Pearl Liu, joining us. So tell us what the major challenges here.
So, unlike in U.S., those Chinese developers here, they got liquidated not actually by their own willingness. So in many cases, they're not very collaborative. So for liquidators, the major challenge sometimes is they cannot get access to those financial documents. They cannot actually reach out to the directors. And because of those troubles, that leads to some extra funding. And they could either turn to the Chinese developers who already got bankrupted and that does not have extra money, and also those creditors who have already lost a lot of those money in Chinese developers will also not willing to pay.
Are there any signs of creditor payouts yet?
So far, we have not seen much progress on that part. a lot of those liquidation orders actually were issued like two years ago or last year. On those cases, we have not seen much significant progress.
If funding is the major issue here, then Pearl, I mean, is it possible that they can find new investors to help?
They could turn to litigation fundings, but for those investors, they also have their own concern. For example, like the onshore-offshore dynamic, it's a little bit difficult to seize those assets in mainland China, and also because there are not many successful cases, they also have their own concerns when deciding whether to fund.
So are more wind-ups inevitable? I mean, we were just talking about Country Garden yesterday. That can getting pushed back to January, but this process seems to be something we'll be stuck in for some time.
Yeah, we are still seeing like at least 8 developers are still at the court procedures against the wind-up petitions. And if they cannot persuade the judge and the creditors, they are moving forward on their restructuring talks. Yes, I guess we will still see more liquidation orders coming.
All right, Pearl. Thank you, Pearl Liu there, our China credit reporter. On the latest, it's not just the mainland story. We're focusing on the Hong Kong property market as well, because some rich families here in the city are really feeling the sting from the city's property slump, with several selling homes and offices at losses to pay back these loans. I mean, you take a look at some of these deals, and they did come with some pretty steep discounts, right? So you take a look at some of these in the Park, or the Peak, I should say, district. So 4 properties at 46 Plantation Road, but basically were sold at half the price there. And we're also talking about this AI Essential building. That family there sold the stake at a $20 million loss. And talk about others, too, basically. Similar story.
Yeah, I think the 30th floor at the Bank of America Tower that sold at a loss, of course, from the purchase price of 4 million Hong Kong dollars. I guess let's get to the bottom of this. Is there some consistent thread? Let's bring in Crystal Chia, our Asia investing and real estate reporter, here with us on set to talk us through this. And they need the money. Is that really what underscores this?
Yes, well, they need the money because right now these rich families, they are being hammered by high interest rates, because we know that Hong Kong rates follow that of the US Federal Reserve, and also property valuations. So they are basically being cornered by these 2 factors. And the interesting thing, or the secretive thing, is that these families, they don't really disclose why they need the money or why they are in trouble. Right. But we know it comes amid China's economic downturn, geopolitical tensions, and a couple of other headwinds.
Yeah, if people that have the cash for this, I mean, these probably look like a steal right now. I mean, why would people be buying in this downturn, and who is buying?
Yeah, so the people who buy, they are mainly high net worth individuals, and they are cash rich. So meaning they are able to pay the whole transaction in cash, which is good for the sellers. There are 2 types of buyers. One is the local Hong Kong rich person who can afford this full cash transaction, and the other would be people coming from the mainland. And this group of investors, whether they are buying for investing or self-stay, they have been heading a lot of the top transactions in Hong Kong nowadays.
Yeah, we've been talking about how the Fed is likely going to start cutting rates. Will that help, or do you think this trend continues?
That would help the buyers, because that would mean that the trend of families having to put their properties up for sale at a discount would only amplify in the next next 6 months. And you can imagine that as this situation goes on, these rich families, they might have to pay an interest rate of maybe 5%, 6%, and actually the rental yield in Hong Kong is not that high, maybe 2 to 4%. So that would mean that a lot of them will run into cash flow problems, and then they might have to put their property up in the market.
And what is the impact of this trend then on the overall property market? Are we just going to talk about a more downturn in prices?
Yeah. That's exactly what's going to happen, because once you have more distressed sales, you have lower prices, and people are just not willing to pay as much for these homes, even though they are really iconic and unique luxury homes.
Crystal, thank you, Crystal Chia, there, Asia investing and real estate reporter, joining us here in Hong Kong. Of course, you can get an insider's guide to the money and people shaking out the finance hub in our Hong Kong edition newsletter that's out every Thursday. You can sign up through our website, bloomberg.com/newsletters. Some stories that we're following for you today. Singapore's Temasek is planning to invest $30 billion in the U.S. market over the next 5 years, with North America remaining its top and largest recipient of capital. The state-owned fund told Bloomberg it's also looking to invest in AI-related firms, plus semiconductor and infrastructure plays. Temasek's investments for North and South America surpassed China this year for the first time in at least a decade. Disney's Deadpool and Wolverine has clocked the biggest box office opening of the year. It took in $211 million in North America during its opening weekend in cinemas. But couldn't clinch that top spot in China, though, beaten by a local comedy successor. And that underscores the challenges Hollywood studios still face in China, which was once a goldmine for U.S. releases. Heineken shares slumped in Amsterdam after the beer maker took a nearly $950 million impairment on its stake in China's largest brewer. It says the value of its stake in China Resources Beer tumbled on concerns about consumer demand in Asia's biggest economy. Similar weakness in the U.S. and Europe saw the brewer narrow its forecast for full-year profit growth.
The impairment that we had to take, a non-cash impairment, is a technical adjustment that we have to do because as a minority participation, we need to value this on the share price, and the share price of CRB listed in Hong Kong dropped below the level that we acquired the company.
Okay, staying with booze, but a different kind here. So UBS out with a note here on Chinese liquor makers. So some of the Baijiu stocks are falling. Maotai, as you can see on your screens, 1.8% on the back of a downgrade from UBS. Talking about how the Baijiu sector will be facing a worsening supply demand dynamics over the next 12 months as you have industry leaders expanding capacity, while it will take time to clear inventory held at the distributor level and also on the consumer level. That's what the broker said in this specific report. Maotai, for example, at 1372 is now in fact trading at the lowest since October 31st of 2022. If that is familiar to you, of course, that was a time, I think a day after that, or a few days after that, is when China came out and said it was removing some of the restrictions around COVID-0. So we're back to that level as far as Maotai is concerned. Right. The broader markets are looking like this. If this is really dragging down part of the benchmark, and obviously it is the biggest stock, heavy weighted stock, I think still is. On the CSI 300, we're down 1% there. Hang Seng is down 1.3%. MSCI China 1.24%. We are just coming off lows on the Hang Seng Index, although 17,000, we've been bobbing around that level, dip below it very, very quickly. We are, though, getting, as you can see, though, incrementally better as you go down the market cap scale. CSI 1,000 is only down 0.5%, and you brought it into the 2,000 benchmark. We are actually getting some green on your screens there. Where you are getting some green is on the CGB market, where this rally continues for a second day so far this week. Right, SK Hynix, some earnings coming. Well, as far as chip story is concerned, as you can see, of course, we are looking at, well, further weakness here across some of these names. Of course, NVIDIA is still in a couple of weeks, but, you know, TSMC at 1.6% to the downside underscores what a challenging month July has been for parts of this ecosystem, specifically Taiwan, right? So TSMC and the entire Taiwanese stock market is in fact on track for the worst month so far this year.
Yep, we are seeing some live pictures here with U.S. Secretary of State Antony Blinken and Defense Secretary Lloyd Austin meeting with their counterparts in the Philippines and talking about this 4-year relationship, or a years-long relationship that continues to solidify there. This is Bloomberg.
Really hard with the yen at the moment, because you just cannot underestimate the willingness of the Bank of Japan to do the opposite to what the market expects and to wait too long to do the right thing. And we've seen that so far already over the course of this year. That said, there is, we think, the likelihood and the possibility of those safe haven flows returning. In the near term, I think there's a lot of event risk around the Bank of Japan this week. The real risk, they just don't cut, and they underwhelm with the rollback in bond purchases, because that has been their MO for the last many, many years.
Right, just going into the Tokyo lunch break, of course, we were just speaking with Isaac Poole. That was about just 15 minutes ago, talking about how the yen likely strengthens. So we made him pick, unfairly enough, we'll see, between 145 and 60. So he thinks 145 is more likely than 160. Although you got to load up on hedges because the next couple of days is going to be fairly volatile. Going into the lunch break, and of course we are day 1 of 2 of the BOJ's policy meeting. We're looking at weakness across the currency and how we've strengthened on the currency, right, from 160, 162 to the current level. So as you can see, traders are in fact bracing for more massive yen swings ahead. So at the current level, we're in fact testing the highs of this year, an overnight implied vol, which then captures tomorrow's meeting. We'll see how this moves, of course, over the course of the session, especially when London wakes up. And certainly ahead of that decision tomorrow out of the Bank of Japan, it's certainly worth mentioning as well that we did hear, of course, from Taro Kono talking about how we probably need to consider this weak currency. Have a look.
The currency is a problem for Japan. The yen's too cheap, and we need to bring it back. The Bank of Japan need to increase interest rate, and they are still afraid of not deflation, but bring the economy down. But I think the lower interest lead to the weak yen, and that push up the price in Japan.
And let's bring in our Bloomberg Opinion columnist, Gerode Rady, is with us right now. They put us, of course, a opinion piece today ahead of the BOJ. Gerode, take us through your column here.
Yeah, so one of the things I found interesting ahead of this meeting is the political pressure that seems to be exerted on the BOJ. You had a clip there of Taro Kono, obviously cabinet minister, calling for higher interest rates, or certainly suggesting that maybe interest rates should be higher. That was followed by another very senior figure, Toshimitsu Motegi, who is the Secretary General of the LDP. That's basically the sort of second most senior post in the LDP. And he made similar sentiments, and they both brought up the yen. And it's unusual in recent years, I think, to see this kind of political pressure, especially from, we're not talking about opposition politicians here. We're talking about people who are, insiders. They're the ones who are, putting pressure on the BOJ and on Governor Ueda, who already, I think, has a very difficult balancing act. So, in our column, we were talking about the fact that, or our belief, I should say, that Ueda should probably ignore this pressure, especially as it comes ahead of the LDP presidential election, which will happen in a little over a month now, or about 2 months, I guess, from now. And both of these figures who are calling for higher interest rates may enter the race to become the next prime minister themselves.
Yeah. You're saying basically ignore these backseat drivers. I love what you called them, Gerode. What does it mean, though? I mean, it seems like there seems to be some, I guess, tension, or at least different views being shared between sections of the government and the central bank.
Absolutely, yeah. One of the other interesting things that we go into in the column was suggestions that the Bank of Japan and the Ministry of Finance might not be seeing eye to eye on where interest rates should go. We threw back to 2000, which is the infamous meeting in which now Governor Ueda, then member of the Policy Board, dissented when the BOJ for the first time abandoned the zero interest rate policy as it was at the time. Ueda dissented in that case, calling for more time. And that ultimately proved to be the right call. The Bank of Japan back then had to quickly retreat from that move. I think you could see a similar situation here where MOF is being, the Ministry of Finance is being cautious. The data certainly does not seem to back, in my view, to back any rapid, interest rate hike. Ueda was cautious back then in 2000, 24 years ago now. And in our view, I think he should continue to be cautious and watch the data here again tomorrow.
All right, tune it all out, as you say, Gerode. Thank you, Gerode Rady there, our Bloomberg Opinion columnist joining us out of Tokyo. And sticking with Japan now, even when we see costs rising, many small businesses are struggling to figure out just how to raise prices after decades of deflation. The pressure has prompted some business owners to take classes on how to negotiate for higher prices. That's our big take here this morning. Let's bring in our senior editor, Reed Stevenson. He has more. Reed, a fascinating sort of experience that you had. I understand you sat in one of these classes. Yeah. What was it like?
Yeah, indeed. I mean, it was really interesting because, you know, this is far outside of Tokyo, which kind of tends to dominate headlines. And, you know, this is where sort of you see some real businesses and real people. And here you had a class of people from surrounding, you know, mostly manufacturing businesses. And if you think about it, you know, if deflation is in place for like 3 decades, many of the people now sitting across a negotiating table at these smaller companies, they've never asked their customers to pay more. And so, you know, they sort of took the step of, well, we need to kind of get this skill that we were never taught or had to use. And so therefore, I found this class out in Matsue, which is sort of on the western side of Honshu, the main island of Japan, and sat in and listened to the instructor sort of walk people through, you know, how to transfer costs to customers, how to lay out a case to raise your prices for customers.
Yeah, it's such a weird, just a surreal environment to be doing business where, where there is pressure to raise prices, but the soft skill isn't there, isn't it? Talk to us then, why is it particularly among the smaller firms that there is this difficulty in being able to communicate and even raise prices themselves?
Indeed. I mean, the big companies in Japan, like, you know, the Toyotas and the Sonys, they know how to raise prices. You know, they deal with inflation outside Japan. Most often they're exporters. And so they are accustomed to this. But within Japan, these smaller companies are actually, in many cases, the supplier to these larger companies. And you know, for a very long time, because of the stagnation and the deflationary environment, you know, these small to mid-sized businesses, which actually make up 90% of the companies in Japan, are at the mercy of these larger businesses. And when you go and sit down at a negotiating table, you know, very often your customers are much bigger and much wealthier and just more powerful than you. You know, you're sort of at their mercy. And so, to a certain extent, you know, taking these classes also just is a way to sort of regain a little bit of confidence, knowing that, look, your customers are making a lot of money. Now, you know, you should be allowed to make more money. And ultimately, you know, what's going on here is that unless these smaller companies are able to raise their own incomes, they can't pay their workers more. And unless they pay their workers more, they're not going to be able to go out and spend money. Even now, when they're seeing, you know, the employees that is are seeing their costs rise, and this is the exact sort of inflation that the BOJ is looking for. They want this sort of healthy wage price cycle to really kick in and sort of act as a flywheel on its own. And so this is, you know, absolutely critical for the Japanese economy to get to the place where you see normal interest rates, you see normal economic activity, and henceforth normal monetary policy.
And you profiled this one specific company in your piece, Hinoden Electric Industries. You know, what did you learn about, you know, how they're approaching this? And of course, what did the instructor teach them too?
Indeed. So the small company, it's a small company that makes control panels that controls water pumps and machines and factories. It's very small, 30 people. And essentially, you know, the man, Mr. Shiratsuki, who runs the day-to-day operations, 44 years old, had never really pushed for higher prices. And so he went to the class to learn how to sort of make a case using publicly available information. For example, energy costs are going up. You can cite those. They use a lot of copper cables, and so the price of copper has been going up over the past few years. And so sort of using logic and just sort of publicly available data in order to make the case. And then the instructor, he's been going around Japan teaching these classes and showing smaller companies how to transfer costs, you know, to their larger customers.
A fantastic piece, suffice to say. Reed Stevenson, our senior editor there, for more on the story, for our clients, of course. You can check this out. Also, by the way, it's on the internet. So Big Take, of course, of the Asia podcast. New episodes are dropping every Wednesday. So find it on Apple Podcasts. If you have Spotify, then you can find it there. And, of course, also on iHeartRadio. There we go. Learn to raise not just a glass, but prices as well. There we go. Plenty more ahead. This is Bloomberg. Right, welcome back. You're watching Bloomberg The China Show. Let's get you the latest now in this 2+2 meeting taking place in Manila. So the U.S. and Philippines, both the foreign ministers or secretaries or counterparts, and also the defense chiefs are sitting together in Manila for the so-called 2+2 dialogue. You have Antony Blinken, Lloyd Austin will be sitting across, of course, their counterparts, Enrique Manalo and also Gibo Teodoro. Now, Blinken and Austin have met with the President Bongbong Marcos, reaffirming Washington's support for the Philippines to defend its sovereign rights amid tensions, of course, with China.
Let's get to our China correspondent, Min Lo, joining us now. The U.S. expected to announce this $500 million in military funding to really boost Philippines' defense this year. How does this change the calculus in terms of security ties in this region?
Yes, so it looks like Blinken is really on this very turbocharged itinerary around the region, visiting 6 countries, trying to sign more agreements, perhaps to lock in a more solid legacy that will be more difficult for a new president to undo. And here, AP is publishing that perhaps Washington may be announcing a $500 million deal to bolster Philippines' military defense. They are also trying to make progress in a military pact that could see the U.S. deploy more high-level intelligence and more sophisticated weapons, including missile systems, in the Philippines. Now, if the U.S. sees this as a step up in deterrence, Beijing is going to see this as a step up in provocation, especially after Beijing and Manila had already come to a sort of temporary agreement to allow those resupply missions to the disputed Second Thomas Shoal. And this also comes after Blinken was in Tokyo, where he agreed to step up military cooperation in Japan and revamp the military there. So Beijing is going to see this as an encirclement of the country with U.S. footprint in the region. So not really setting up a very stable backdrop for the future of peace and stability in this part of the world.
Yeah, in the meantime, it's busy on foreign policy and high-profile meetings in Beijing. Of course, the Italians are in town, and of course, they did meet, of course, with Chinese President Xi Jinping.
Yes, and Meloni is trying to achieve a number of objectives here. She really wants to reset relations after she had pulled out of that Belt and Road Initiative, quite tricky after she said that there was a big mistake for Italy. And now she's trying to broker better trade relations with the EU as well after Italy had also supported those EV tariffs on China. And at this point, it's actually not clear how much clout Meloni actually has over the EU's trade policy, given that she was also sidelined during the EU parliamentary elections. She was kept out of closed-door negotiations for the union's top jobs. But certainly both countries are now trying to manage any potential fallout from that tariff, with President Xi saying he's hopeful that Italy will provide a non-discriminatory environment for Chinese firms. And Meloni is also calling for more balanced trade relations here. And then, of course, you have those geopolitics in focus. Meloni raising the issue of the Ukraine war, the Gaza conflict. She's seeing President Xi as an important interlocutor when it comes to managing global tensions, especially ahead of these potential uncertainties about Washington's commitment to Europe and to Ukraine as well.
Okay, Min, thank you so much. Min Lo, there, our China correspondent. Now, in the U.S., and staying on politics here, Vice President Kamala Harris' campaign is looking to sustain its momentum here with a range of polls showing actually the gap with Donald Trump is narrowing, and that's ahead, of course, of the Democratic National Convention, which I'm looking at my dates here, about three weeks away. But Bloomberg Opinion columnist Karishma Vaswani says Harris isn't so popular in one place. Karishma joins us now for more on that. And what place is that, Karishma?
David, it's China. You were just talking about that with our China correspondent there. And one of the reasons why Kamala Harris isn't so popular in China is because she is seen as the unfamiliar, an unknown quantity. You know, Beijing has dealt with Donald Trump before, right? I mean, we all did when it came to the U.S.-China trade war, the very sort of erratic, I think it's fair to say, foreign policy, trade policy in particular. But they're not so sure what they're going to get in the form of a Kamala Harris presidency. What they think they'll get is more of Biden, particularly when it comes to President Biden's approach to Taiwan. And of course, that is the red line for China. Any hint that its position on Taiwan, which is to reject Taiwanese independence wholeheartedly, could be challenged by anyone, but in particular the United States.
So it's interesting, right? Because, you know, when people talk about Trump 2.0, the big threat of 60% tariffs is certainly something that looms on China. So even in Beijing's case, they still rather deal with someone that is familiar than someone that they don't really know, you think?
Yeah, I mean, certainly that is the sense that I've been getting. But it's not just about trade tariffs, right, Yvonne? You've got to look as well at what Trump did in that time, which was to bring America away from engaging with the world. It was very much about America first, rather than America being part of a wider global conversation, and particularly the way you've seen the Biden administration, I should say, engage with Asia and Southeast Asia and in the South China Sea. Now, when Donald Trump was last president, he pulled out of global trade accords, climate accords as well, and really showed the fact that it was very much the world on its own and America first. I remember sitting at an APEC conference, where he talked rather proudly of making sure that if the United States was going to engage globally in the world, it was going to have to be on the U.S.'s terms. What you've seen with the Biden administration and what is likely to continue in any eventual Harris administration is greater engagement with Southeast Asian and Asian countries. China does not want that. It wants the region to itself. It considers it its crucial backyard, and an isolated America is better for a China in the future.
Karishma. Thank you, Karishma Vashwani there. Make sure to check out her column this morning. Our Bloomberg Opinion columnist joining us out of Singapore. Some of the stories that we're following from around the world this morning. South Korea's spy agency says North Korean leader Kim Jong-un's preteen daughter is being trained to take over the country. The agency told lawmakers that Kim Ju-ae, dubbed the respected daughter and beloved child by state media, is a candidate to be next in line to rule North Korea. She's believed to be the second of Kim's 3 children with his wife, and currently aged about 11 years old. Several fiber optic cables carrying broadband services across France have been cut in the latest attack during the Olympic Games. Olympic telecom partner Orange says connections to Paris and the Games were not affected. It's a second apparent sabotage of French infrastructure in the past few days after a series of fires disrupted trains ahead of the opening ceremony.
Right, just ahead here on the China Show, Hong Kong's best Olympics ever. More next on the city's latest Golden Games moment and who's leading the medal tally over in Paris. This is Poole.
Welcome back to the China Show. Your medals count for the Olympics here is still, we're still seeing Asia dominate so far here, with Japan still leading the top here. Yeah, but what's not on that chart right now that we're about to show you? Top 10, Hong Kong's still there, right? I mean, this is the best Olympics we've seen for the city. And I think there's a lot of Hong Kong people, at least in my Instagram feed, were up at like 4 or 5 a.m. this morning watching that fencing final.
Well, they now know what we feel like, being up at 3, 4, 5 in the morning. No, but yes, second gold medal.
Oh, yeah.
Right?
You won last time. Edgar Zhang, we're saying. Zhang Galong.
Yes. And of course, he simply, I think he defended his gold medal, of course, which he won in the previous Olympics, of course, in Japan, which was delayed by about a year because of the pandemic. So 2021, and we woke up this morning. I went to bed, actually, that he had just won the semifinals, and then I would just allowed myself to be pleasantly surprised when I woke up this morning. But yes, here we go, the best ever Olympics yet for Hong Kong. So 2 straight now.
Oh, and he was so dashing the way he did it. Just what I watched in the highlights as well. Does not forget Siobhan Hawley as well, won her bronze. In swimming as well.
I didn't know swimming competition was already.
Yeah,
okay.
So she won the bronze. I don't know which one it is, but I think she's competing in the 100 meters
I have the internet
later on today. But yes, that was also another medal for Hong Kong. Yeah. Okay. Take a look at some other things that we're looking at. Okay, so there's a lot of controversy. We talked about the beds, right? And the cardboard beds. And so it looks like there's like a different camp. There's the one that says, look, I want the experience. I'm going to stay and live in the Olympic Village. And then there's another camp that says, like, I'm just going to go to the hotel.
Right.
I think the NBA, some of the basketball players in the U.S. have always gone that route, the hotel route.
I don't think they've ever stayed. Well,
No.
I don't want to say ever, but the previous Olympics, they haven't stayed at the Olympics.
Since the 90s or something,
Village.
right? Yeah, so I think LeBron James was saying, nah, I saw that on Instagram. But Nadal was on the other side saying, look, you got to be with the other athletes. That's what you want to be. You want that whole experience.
The Olympic spirit.
It might hurt your back a little bit, but hey, it's worth it.
I remember it. So I'm trying to put those two stories together. So I remember Charles Barkley was talking about from the original Dream Team in '92 in Barcelona, and he talked about how the Olympics was an experience like no other. Just because of the spectacle of the event. But again, they had to stay on that point at their own hotel because the madness around the Dream Team won. They could go nowhere effectively without getting mobbed, right? But
plus, they're like, what, 6-7 feet tall?
Yeah.
They would need like a few beds, I think.
4 cardboard beds.
At least.
To house your NBA players. Anyway, okay. This time again tomorrow, your usual update and banter on the Olympics coming up as well. What do we do from here? We're looking at markets right now. Hang Seng Index, Hang Seng Tech Index. And just to underscore as well, we have some commentary coming through out of the China Customs Bureau, an official. They're talking about how the outlook for the second half, as far as the external trade environment is concerned, is increasingly uncertain, and China is facing challenges when you look at what's ahead, of course, as far as exports go, which has, of course, held up quite nicely.
Yeah, I think the external picture, maybe they're saying, is looking a little bit less certain right now. So certainly that leaves a lot of question marks of what this economy is going to look like. And we just had the likes of Citi coming through, downgrading their growth forecast for the year to 2024, really citing the weakness that we saw in the second quarter. HSBC's Jing said, we've kept our forecast at 4.9%, sub 5% for some time now. We really haven't changed that, despite that strength that we've seen in the export side of things. But yes, this is what equity markets are doing as we count down to some big events coming up here. Hang Seng just teetering around that 17,000 level here right now. That's it for us here at the China Show. Bloomberg Markets Asia is next.